Okay, assalamu alaikum wa rahmatullah, dear students. Hope you are doing great today. So today we are going to start our lecture 6 on entrepreneurship, and we'll be talking about analyzing cash flow and other financial information. So this lecture is going to be very interesting because it's going to highlight some important dimensions that are mostly being ignored by the entrepreneurs, because sometimes they are too much excited about the product and they're just too much focused on its production and all these things. And then they are focusing on selling, but they do not realize the importance of the cash flow. So this might sound a bit boring because we're talking about the cash and financial things, but in reality, it's going to have a huge impact on the success and the failure of an entrepreneurial setup. So today's learning objectives are to recognize the importance of cash flow, understand the difference between budgeted statement and cash flow statement, understanding break-even analysis, and understanding entrepreneurial break-even. Okay, let's start our today's topic. Okay, so we'll be starting with the cash flow. What is cash flow? It's actual cash that flows into the firm minus the cash that goes out of the firm. So it looks very simple, isn't it? Like how much cash we are bringing in and how much cash that is going out. So it's not the same as profit. Profit is something different. It's like, we have to understand the cycle of the cash, how the cash flows out and how it flows in back. So there's a difference between what the cash goes out and what the cash comes in. So if you keep in mind your business that is a new business, so new businesses, they might be struggling with the cash flow. The problem with that is that you might have lots of earning, but that earning is not with you. That is in the market with some, suppliers, some vendors, some retailers. So your retailer might have purchased from you, say, 10K of inventory, and then they promise to pay you within 5 days. So there's like 5 days of delay cash. So you would not have sufficient amount of cash to get more, say, raw material for your production. So there can be a gap between the cash that you might need to get from your customers, and there will be a gap between when you'll have to pay for the suppliers and other, the rent and the salaries and lots of things that involve cash. So you must have a sufficient for the purpose of business to survive at its early days that thrives as an established entity. Why are we talking about the early days? Because once you are an established entity, then your suppliers will trust you, and they might give you, certain kind of incentives that you can pay the cash later on. So there's a famous terminology that we normally use in finance that is called 210 and 30. So according to this formula, the supplier, when you are an established business, they will give you a cushion period of 30 days to pay the cash. So you will have 30 days to pay the cash, and they also give you 2% incentive if you're going to pay them like the whole payment within 10 days. Similarly, you might be offering this to your customers if your customers are, say, business to business. So you might be offering them 210 and 30, which means like your cash would be stuck with them for 30 days if they do not want to get the 2% discount, which they have to pay for the 10 days. At least if there is going to be 10 days, say they want to achieve get this 2% discount for 10 days. Still, your cash is stuck up with them for 10 days. So once your business is established, you might be able to get these kind of facilities. So that's why it's important. And sometimes when you are new in the business, your initial startup cost, which we call it inertia, can be higher. But when your business is running, then it won't be a problem. So let's go and see what is cash flow and what is negative cash flow. As we discussed in our example, carrying inventory of any type results in payments of these suppliers. We discussed it in the previous example that when you'll be getting some raw material or inventories, you'll have to pay money. So it's a negative, yes. Take place long before the cash is received. So you might be requiring your raw materials, you might be, say, getting a building on rent, or at least buying a land and then developing a property on the land. That is a cost that is involved, yes. And then buying, cars and other machinery. So there's lots of cash that might be involved in this whole process. So you might face a problem that is called cash crunch. It's the person when the sales grow. So when your sales goes up, there is a chances that you might face a problem with the cash crunch. It's when new entrepreneurial business must accurately forecast its real cash flow to prevent a cash crunch. So the cash crunch is basically a problem that you are run out of the cash. Yes, you have lots of, say, millions of dollars that is account receivable from the customers, but you don't have enough cash to meet the current bills. For example, you do not have enough cash to pay to the truck that has bring for you the raw material, and the truck driver is waiting for you to make payments. Similarly, you might have not enough cash to pay the salaries, or like small things like that. So we need to be avoiding cash crunch, especially in the start of the entrepreneurial setup. Importance of a cash flow analysis. Why we do need to understand the cash flow? Because as I told you previously, it will define the success or the failure of the business. This is where most of the businesses, they get strangled and they could not progress. So in order to be successful, the businesses need to understand, and especially the entrepreneur need to understand this cycle. So we need to understand the cash flow statement during due diligence stage of the new entrepreneur, a new venture. It differs from the financial analysis generated by an ongoing business. So as we just talked about, new businesses, they have many costs that are involved. They may be different than the established business. So established business, every costs are kind of known, or most of them, they are known. But for the starting a new business, we call it inertia of the business. The initial cost might be very high, and then with the passage of time, you can overcome this cost. As I told you, like if you want to buy a land, and then you build some property on it, or you just get a rent and you want to pay rent upfront. At that time, you are not earning nothing. So you are making cash outflow without having cash inflow. Then you're buying some, say, vehicles, forklift truck, and then you're getting some labor. So all this cash is what you are paying outside. For proposed business, the focus is on its ability to generate positive cash flow in the shortest possible period. So a successful business should try to generate positive cash flow. Means that it should be starting earning. We are not talking about the profit and profit margin right now. We are just talking about how early we are able to get some cash back. So there has to be a viability of the firm will be decided. by cash flow, not profitability. So these two things are different. Profit is desirable, but cash pays the bills and payroll. Okay, what is float? The bills and payroll. Okay, what is float? It's a difference between when the money goes out and when it comes back. For example, if individuals deposit a check today in the payments for some goods, the business typically does not receive the cash when they deposit it. And also imagine, like, if your customer has paid you a check today and say they paid at 4 p.m. and imagine that it's like the banking hours were like 5 p.m. so you could not deposit it today and it goes to tomorrow. So that is one day extra that has been added. So, and then there may be sometime they pay you like a future check. They might give you for the 31st of October, not for today. They will say like, please cash this check on this day. So there's a period of float before it is credited to our account. So that float we need to take into account. That delay of receiving the cash we have to take into account. Okay, what is budget? The statements that projects all the costs that can be incurred by the organization over a period of time and allocates those expenses evenly over the relevant time period. So the point is that we should be able to understand the real cash flow. It should not be confused with the cash flow statement. A budget is like the overall expenses, and we'll be looking for over the period of time. So it helps us, but one needs to know the amount of cash he or she needs to pay the bill, because budget is looking on the bigger things and cash is the real source that is making this thing happening. Okay. Let's have a look on this budget for a startup software firm as an example. Okay, so in the start of the Jan, we received in this month $6,000 real of total receipts. Total disbursement we made in this month were 8,621. Like this is like payments out, and this is plus, yes. And like this was the start of the our entrepreneurial setup. So we basically injected 10,000 real or dollars of equity into the business. So with the help of this 10,000 plus 6,000 and negative 8,621, we got a net profit or net loss of, say, this one, 2,621, and ending balance was 7,379. Why? If you just 10,000 plus 6,000, 16,000 minus 8,621, that will give you 7,000 and reserve. So that can be your balance for the January month. Now, if we do the same exercise for the February, so in February we have got a decent number of receipts, and our disbursements are almost the same as we had in January. And now in this month, our total like net profit or net loss has decreased like a bit, 671. So in the next month, we had like some ending balance which is equal to 6,708. And starting with the March, we again see like in the March, same goes like this, and we still face a net loss of this, but still we have an end balance of 6,537. And our profitability starts from the April. because in the April we have received a good number of receipts. So our many other businesses, they have started paying us back, or our account receivables are being realized. So in this month, you see the disbursement, total disbursements are almost the same, and the beginning balance was 6,537, and this month we have achieved some profit, which is 5,329. And then this process goes on, like you see if the profit margin is increasing over the period of time, and because the number of receipts are being increased. So in this example, you can see like in the June month, we are getting like 20,000 real or dollars of receipts. So this example tells us that these are the tough months, you know, start of the, say these 3 months. So you should have, by this example, at least a cushion margin for 3 months so that you will survive. So if you survive this tough time, you will get good outcome and profitability in the future. Is this clear to all of us? Okay, tamam. So it's very easy, inshallah. Now we will try to see the cash flow statement. Cash flow statement for the startup firm. This is again an example. So here we'll be just talking about the cash. So see, like if we have in the January, we had a cash flow receipts for 3,350 total receipt, and the total disbursement that we made, like this is like plus, that's what we got, and this is what we given out. So then we have to check the net cash. How many we have cash? So we have a negative cash. Okay, and then we will try to see the ending balance. This is the cash which we have in plus at end of the month. This was happened because of this. The money that we injected into the business, this is our equity, this is our investment. Okay, so again in the second month, if you just try to look from this cash flow, we see that we have received some 4,050 in terms of the receipts, but we paid out 6,784. And then if you see the starting balance, that was 4,257. So if you see it from the cash perspective, we had negative net cash flow, but still we had an ending balance of this. So out of say 4,257, we deducted this, and we had at least 5,523. So March 3, we have some cash in hand, which is $60 a real. In March, April, again, and the balance is like this, and this is again a negative cash flow. And we started to experience positive cash flow during May, which is 2,775, and then during May, which is 2,775, and then in June 6,690. Okay, so if you just try to see the net cash flows, still, you know, this is negative for the this 6 months. 1, 2, 3, 4, 5, 6. So all these 6 months, we can still see that there has been negative 3,008 in the 6 months. So this is just to try to learn that the cash flow can be different than your budgeted revenue. Okay. So in the budgeted revenues, you can see that there's something that is you are receiving, and or you might be writing them as the receipts. So, but in reality, we are just working it from the cash perspective. How much cash that we have, which is the real money. Okay, so now when we'll try to see, we'll have to see the deviation analysis. And this is important for the new businesses to learn like how much they've been forecasting and how much they are actually getting it. So it's the analysis of the difference between the predicted and actual performance. It assists entrepreneurs to develop realistic forecasts. It is helpful for pointing out differences between actual and predicted performance at the time. It allows maximum flexibility in making changes during the growth. How we can do the comparative or deviation analysis for the startups? See, for the January, we predicted like $6,000 real of receipts, but in reality, we just got 3,350. So in reality, our prediction was less accurate, like $2,650 of real were missing. And in disbursement, we were thinking like we'll be giving away this much money, so like we'll be spending 8,400, and it can be very natural that you might not be able to understand the real cost, and it might go a bit higher. So in reality, you have made some extra disbursement. Similarly, equity, this is like the same equity that we had planned for. Net cash flow, we were expecting 2,400 in outflow, but in reality, that has been 5,743. For example, you have not been able to take into account the transportation cost, or sometimes when you ask for the delivery, and imagine the truck comes over there, and you have to hire a labor to offload the truck. So this extra cost that you are incurring, you in the slightest of your imagination, you never had an idea that you might be paying someone to offload this, your raw material. So these things can also change your budgeted amount. So ending balance can be, you were thinking like we will be having 7,600 positive cash, but in reality you had little amount, which was 4,257. So you were negative, like 3,343. So this is quite natural, because you have not been into the business, you are starting a business, and you don't know the real calculations. So once you'll be doing this, and on a regular basis, you will learn to make the realistic cash flow, which is going to help you in the future. We can also do a sensitivity analysis. It is examining the best and the worst cash flow scenarios. It is essential to development of cash flow statements. So one should know, like, what if all our cash that may be realized on time? So how many cash we will have, and what is the flexibility we can do with this, or what is the maximum that we may not be able to get that cash in this time, and how would we survive? So this is like we need to do some sensitivity analysis as well. Okay, other financial tools, one is called pro forma. This is the term that describes estimations of the balance sheet and income statement will look like in the future. So we can make pro forma for the understanding how the future balance sheet might look like. So the balance sheet is basically a summary of the assets and liabilities of the entrepreneurial business. In the next slide, we will explain you what is balance sheet. Okay, so balance sheet is basically, it is composed of assets and the liabilities. Okay, so on one side we'll have assets, on the other side we'll have liabilities. Why it is called balance sheet? That it has to have a balance. So on one side we like assets, On the other side, we have liability. So assets should be equal to liabilities. Okay. So in assets, we can have, for example, if you have 10K of assets, they should be equal to 10K of liabilities. Okay. This is the balance sheet is among the best practices. Both sides should be definitely be equal. That's why it's called balance sheet. Okay, for asset side, we have two kinds of assets. Like what are the assets? Like the resources or what the business has. So they can have two different kind of assets. One we call them current assets, the other we call them fixed assets. So current assets are like cash, or there's asset that can easily be converted into cash, such as account receivables and notes receivable. So account receivable is again like you have paid someone, you have delivered someone the order, and now you are expected to receive the cash, and they say like, okay, we will pay you tomorrow or day after tomorrow. Similarly, notes receivable, that we will be paying you within a specific time period. So current assets are more close to cash. We have to understand this, okay? So current assets are more close to the cash, whereas the fixed assets, they might not be easily convertible to the cash. So they have some physical presence. They may include land, building, equipment, like machinery and vehicles. So these are also the assets of the business, but unfortunately, you cannot quickly convert them into the cash. So hence you will not be able to pay the say transportation costs, you will not be able to pay the fuel, you will not be able to pay the offloading of the inventory, labors, etc., which is only possible through the cash current assets, current or equivalent to current assets. So in the next side of the balance sheet, we have liabilities. Okay, so as like similarly, we have current assets and long-term assets, fixed asset. We have liabilities, which are current liabilities and long-term liabilities. Liabilities, as we know, we call them loans. Current liabilities and long-term liabilities. Liabilities, as we know, we call them loans, or something that you are liable, you have to pay. So current liabilities means that liabilities or debts, that is again the loan, the entrepreneurial business has to pay within 1 year. So we have a criteria that is 1 year. So it includes account payable, notes payable, such as bank notes and the accrued payrolls. Again, these are like all your commitment that you will pay this within short period of time. Long-term liability, on the other hand, these are the liability that are owned by the business and are ultimately due more than a year from the current date. So it may involve mortgage payments, like you have bought the land on mortgage. It may involve owner's equity, like you as an owner, you have injected some money, like capital into the business, and or the shareholders or the stockholders' equity. That can be like a loan that is not for short term. This can be considered as a long-term loan. So in reality, a balance sheet is a snapshot of a business at a point in time. So it's not going to give you a complete picture of the business, what is its current state of. What it's going to show you is that we have one side, as we talked about, assets, on the other side we have liabilities. And in assets, we will have current assets and fixed assets, or long-term assets. Okay, liabilities, we have current liabilities and long-term liability. Okay, so but the balance sheet should be balanced. For say your current assets are 15K and your fixed assets are 45K. So overall, what is mix? 60K. Okay, so here your current liability. Sorry, this is on. Say it is 20K, and your long-term liability is 40K. So it should also be 60K. Okay, so they both the sides, but it just gives us a static picture of one time. It's called a snapshot. It does not tell us what is happening. So asset minus liability should total to 0. As I give you here, they should be equal. So working capital, which is current assets minus current liability. So this is working capital. If we deduct current asset minus current liability, that will tell us like what is our working capital. So here in this case, it's like 15K minus 20K, which is negative. Say negative minus 10K. It means we do not have sufficient amount of current assets to fulfill our current liabilities. Okay. So this is again a different view of balance sheet. We have assets in dollars. We have say current assets. They have made it like this. I made it like so this portion, this 319 is equal to this one. So they both should be balanced. So assets should be equal to liability. So current asset is like 500,000, fixed asset, total fixed asset, which includes machinery, land, things like that, 340,000. Here we have current liabilities 54,000 and total long-term liability 2 lakh. And then owner's equity, which is your investment, your share in the business, that is 1,35,000. What is working capital? We studied in the previous slide. There was current assets minus current liability. Yes, it will tell us like how much we have assets to fulfill our current liabilities. So our current liabilities are 54,500. So hopefully, if we do 50,000 minus 54,500, we will have minus 4,500. Okay, so this is negative. It means that we do not have sufficient current assets to offset the current liabilities. So we have to generate some other or liquidate other assets so that or to borrow some more loan to fulfill these obligations. Okay, predicting performance. Is correctly predicting a business performance can help secure better terms. Is correctly predicting a business performance can help secure better terms with vendors and suppliers. So if you can forecast your sales, then you can negotiate with your like suppliers and vendors. Like if you, as in the previous example, you saw like we were making positive cash, say in the fourth month, yes. So month 4. So if we are buying something in a small quantity, we might buy it in a long quantity on the 5th month, yes. And when you buy in a long quantity, you will, or a big quantity, you can get some discounts. So that can help you to negotiate good with your vendors and suppliers. But if you can predict it accurately, imagine if you do not predict it accurately, then it's going to be a problem for you. Okay, there's a small difference between balance sheet and income statement. In balance sheet, we remember that we are talking about assets and the liabilities. Assets versus liabilities. Here in income statement, we are talking about the revenues, the income, and then the cost. So revenue of the firm minus its expenses. Here we are talking about the profitability concept. Okay, so focus is on the profit rather than the cash flow. Predicting sales for the entrepreneurial firm is a key to developing an income statement. So income statement is linked with the sales. The more sales we're going to have, this should be directly proportional to the profit. So it provides both the gross and the net profit margin, net profit figures. Gross profit equals sales minus cost of goods sold. We will see this income statement in the next slide, and we can explain from there. But we have to understand what is gross profit, which is the overall sales, net the cost of goods sold. So how much cost we have incurred to sell these goods. Gross profit minus all expenses equal net profit before taxes. And then we did estimates. Taxes are calculated and subtracted from the net profit. Let's see it from this income statement. This is income statement for computer sales of the firms. Okay, so let's see it from Jan. So total sales we did were 3,350. What is the cost of goods sold? Inventory imports, that was 17. And what is gross profit? So if we'll deduct this, that will be our gross profit. And if we deduct total expenses, so total expenses will include all different kinds of expenses that we have incurred to sell these products. So that will bring us 5,743, which is a negative figure. So in January, we have experienced a loss of 5,743 real, or you can say dollars. So move on to February. In February, we made like decent sales, which were like 4,050. Again, on the inventory imports, the cost of goods sold is like 20. But if we that gives us a gross profit of 4,030. This gross profit is also called EBITDA, EBIT, earning before interest and taxes. So this one, and the profit before taxes, this one is EBIT. This is important for us to understand, earning before interest and taxes. So in the second month as well, we have total expenses which were like slightly less than the previous month, but again, it has contributed a negative or a loss. In the third month, we also experienced a loss. In the fourth month, we also experienced a loss. And in the fifth month, we have got like 2,775 profit. Okay, guys. So in the June, we have more decent profit after taxes. And then in as a whole, if you try to study all 6 months, we have incurred more loss than the profit for the 6 months. As a young entrepreneur, you might have predicted like after like for say 5-6 months, we will have profit. But if you take it the bigger picture that you had a loss, but still the trend is high, going up. Your sales are increasing from 3,000 to 4,000 to 6,000 to 9,000, 15,000. So it's a decent trend. It's increasing. So it offsetting the cost that we were having. Okay, so I hope you understand this example as well. Now we have to work out which is called break-even analysis. A break-even analysis is important for business to understand. It's the tool to estimate when a business income exceeds its expenses. So as we have fixed cost that must be paid no matter how many goods are sold, such as rent of the building. And we have a variable cost that vary according to the how many goods are being produced. So if we can differentiate between fixed cost and variable cost, and we can work out how many units we can produce to get offset these costs, then we can generate revenue after that point. Okay, so as we talked about, we have a fixed cost which we have to pay at any cost. You cannot run away from this fixed cost. This can be the rent of the building, or you have already paid for the cars and the fixed assets. Now your extra cost, this cost we are talking about, this extra cost that you are incurring, which is a variable cost, it depends on the number of units that we are producing. How many units we will produce, then we will start getting the revenue. So this point is the break-even point. This over here, so break-even. So here, this like our variable cost and fixed costs, they are sum up, and they have been offset. And fixed costs, they are sum up, and they have been offsetted. Now from here onward, every unit that you are producing, that is generating profit for the business, because these units are you're not incurring any extra cost on it. So businesses have to understand how many minimum number of units they have to sold so that they can generate so much revenue that it can make it profitable. Okay, do we understand this break-even diagram? Similarly, the entrepreneur's break-even can be different than the well-established businesses. Like here, they have given a break-even point used for some established businesses. That can be very low as compared to the time, so they can quite early, they can start getting their revenues. Similarly, the initial investment might be very low for the new business, established businesses, as compared to the entrepreneurial break-even, which can be very high because you are just starting off the business. And because the amount of revenue that you are going to generate and when you are going to get the actual net cash flow, there's going to be a difference. So time value for money is important. So sometimes if you get like cash which is delayed, that can be problematic for you. So in this diagram, we can understand like the entrepreneurial break-even can be different from the well-established businesses break-evens. Time value of money, the concept we just talked in the previous slide is basically the value of the money over the time at a given rate of inflation or other types. So we say $1 today is better than $1 which you will get it some future time period. Why? Because we know that because of the inflation, the value of the dollar also decreases. So calculated as the value of your investment in time and money if you did not do the proposed venture. And we also try to see like if you have spent some say 100K of investment into the entrepreneurship, imagine you would have not invested in it, and if you would have kept it in a bank or some other fixed investment. So what would have been the value for that? Okay, so that's it with the financial statements, cash flow. Today's lessons from the famous entrepreneurs, we will be talking about Elon Musk. So I believe you must have heard about him. Elon Musk is an all-round entrepreneur who has the co-founder of PayPal, and currently he is the founder of SpaceX and co-founder of Tesla. His quotation is, when something is important enough, you do it even if the odds are not in your favor. What is the one lesson we can learn from Elon Musk? That we should take risks. So higher the risk in finance, we call higher the return. Okay, today's questions for you to ponder, or hopefully you will be able to address these questions by now. Why is cash flow so important for the new businesses? Why is break-even analysis so important to the new businesses? What elements make the break-even analysis? What is entrepreneurial break-even? Okay, so this is the end of today's lectures. If you have any questions, you are welcome to ask. Or you can send me a message, like if it is clear to you. Okay, sounds good. It's clear. And what about the other students? Come on, good. Okay, it sounds good to me. So I can